And welcome to another episode of the Bull and the Bear podcast. I'm Matt Clark. Glad you are with us on this extended holiday weekend. Hope everyone is enjoying. I just want to remind everyone that we are on a bevy of podcast providers now. Apple Podcasts, we are on Google Podcasts, Spotify. We are just added to iHeartRadio podcast as well just the other day. So make sure you check out any of those, whatever your favorite podcast listening apparatus happens to be. Give us a review, give us a comment. We'd love to hear from you. And we'll also have our email address in the show notes. You can email us as well. We welcome those comments at any time. But again, it is a holiday weekend. Markets are going to be closing up in a couple of hours, and then everyone will be able to enjoy a 3-day break from what has been, I don't even know what to call it. Is volatility even the right word at this point to call what the markets have been this week? I mean, we start up Monday with huge new word. Yeah, and it's just slid backwards from there, and markets were up this morning. Now they're down, and it's just who knows what's really going on. But today we're going to take a little bit different tone, and I'm going to bring in Charles Sizemore, contributor for Money and Markets, and then Money Markets chief investment strategist. I'll spit your title out, Adam Odell, to come in, and today I want to focus on options. And I know that for a lot of investors, first off, the market to especially a new investor may seem rather daunting just because there's so many factors at play. There's so many things to look at. There's so many things that could go, there way more things could go wrong than what could go right if you're not using the right methodology, the right service, talking to the right professionals, things like that. The guys like Adam who can steer you in the right direction, or if you go it alone, maybe you get lucky. Maybe it's kind of a coin flip. So the market seems kind of daunting when you first start, and there's no question of that. But if you get deeper into the weeds, into the intricacies of trading, obviously there's your regular day-to-day buying and selling stocks and buying and holding or day trading or whatever you happen to be into. And that can be, that in and of itself may seem like just overwhelming to anyone. And I think it's one of the reasons why you don't see a high percentage of Americans playing the stock market, because it does seem on the surface rather difficult. And we'll talk about why it doesn't have to be here in a minute. But to drill down even deeper, one part of the market that is really intriguing to a lot of people, but I think it's one of those things where they're really afraid to dip their toe in the water, and that is options. Options is a completely different ball game aside from just buying and selling stock. There's different ways to look at it. There's different metrics to use. The lingo is completely different when you're trading options as opposed to just trading stock across the board. So just when you look at that just seems even worse. That you just look at that and go, well, there's no way I'm going to figure all this out. But really, I don't think it has to be that hard. And I'm glad that I have you two on today, because I think you both agree with me that it's not that difficult. I think people make a mountain out of a molehill when it comes to deciding how to trade options. But the first question I want to ask, and I'll toss this up to Charles, to Adam, to both of you, is first off, one of the misnomers is that options are extremely risky plays for investors to make. That you have the possibility of losing tons of money if you are in options. So first I'll ask Adam, is that, I know the answer, but I want you to explain, is that true? Are options as risky as people believe them to be?
Now, it's certainly a misnomer, and like a lot of misnomers, it's grounded in a bit of truth and a whole lot of fiction. One of the analogies I've used to describe options is there's nothing inherently risky with options per se. That would be like saying that that all boats are inherently risky, that it's just an idiotic idea to get on a boat and go out onto the water. That's not true. Obviously, there are some types of boats, those speed boats that you see flip backwards up into the air and tumble backwards. Those types of boats, when used by inexperienced people, can be very risky. And the same thing happens with options. But on the other hand, if you have a 180-foot motor yacht that's captained by a captain with 50 years of experience or whatnot, there's nothing inherently risky about that particular boat. So you can't, it's an unfair generalization to say all options trading is risky. In fact, options can give you risk limiting techniques, and it's a tool that you can use to limit your risk that buying stock outright can't give. So when used correctly, it can actually be a risk reducing tool rather than risk increasing.
Charles, you see it the same way?
Yeah, I do. It comes down to how you use them. Options, I would say, are you for more people. Options can be used for speculation, of course. It can also be used for risk reduction. But most importantly, and this gets to what Adam does, options give you the ability to define the risk you're taking. If you want, it lets you quantify it and take exactly the amount of risk you want to take. So, are they risky? Well, they're exactly as risky as you want them to be.
Now, explain that a little further. Let's dive a little deeper into that, because I think that kind of glazes over the top of risk management when it comes to options. When you say that you can define your own risk, basically, tell me, and this is for either of you, tell me exactly what does that mean. If I'm a new investor and you tell me that, explain that a little further.
Yeah, I'll
Oh,
jump
sure.
on
I
that
can
one.
jump in first. Or no, go ahead, Adam. Go ahead.
So basically, I mean, there's a couple things you can look at. First of all, you define your risk when you put the trade on, and that's a little bit unique relative to stock purchases. And what I mean by that is when you buy stock outright, you're often buying 100 shares at a time or more. You want to put in a 100 share order. You usually have to use a stop loss order because you don't want to lose your entire investment in that 100 shares of stock. Let's say it's $100 price per share stock and you buy 100 shares, you're in it for 10 grand. If you don't want to lose that full 10 grand, then what most traders will do is put a stop loss order in, says, if this goes down by 20%, then sell me out. Well, I've written before, stop loss orders are not fail proof. You can have a gap through the stop. You can get a bad fill on illiquid stocks if you use a stop. So that's you basically, when you buy stock outright, you cannot guarantee that you won't lose more than you really want to lose. When you buy an option contract, which I'll note, often option contracts are only a couple $100, $200, $250, $400. You basically cannot ever lose more than you've invested in that option. So you can size your position a lot more conservatively if you'd like. Again, it's risking only several $100s rather than tens of thousands of dollars. And you don't have to worry about the gaps. So that's one reason why options trading is actually less risky, even for speculative directional bets, than buying stock outright.
And it makes sense to look at options, especially whenever, I say this over and over again to people who are looking to invest or trying to figure out what to do, is I say, okay, don't risk any more than you are willing to lose. If you are willing to lose $1,000, then do not put any more in the market than $1,000. And however way you do it, whether you're buying ETFs, whether you're buying REITs, whether you're in mutual funds, whether you're buying straight across stocks, whether you're in options, doesn't matter. Only put in what you're willing to risk, what you're willing to just part ways with. Then you're not going to be damaged so much if the losses do incur the losses. Options is exactly that strategy to a T. Yes, I mean that's exactly how it works, right?
Yeah, in fact, we assume that on a small percentage of our trades, we assume that we are going to lose the full debit or the full cost of that option. And for me, I'd rather go into a strategy with that assumption and knowing that I can come out the other side, even if that assumption holds true, meaning even if on a small percentage of our trades we do lose 100%, that we can still come out of the other side of those losing trades with still have capital, still have net profits overall. I'd much rather go into a strategy that way than to not make that assumption. And if something bad happens, then you do lose a lot more than you're bargained for, or that you're planning for. So yeah, for me, that's really one of the key advantages of options.
Now, Charles, I'll ask you, is there a certain threshold that an investor should have when they're looking at options? I mean, because you can invest too much. I mean, you can go overboard. Is there a limit? Say, if I'm a new investor and I say, Charles, I'm looking at options and I want to invest in options, how much money should I put into it? What would you tell me if I asked you that question, Charles?
Well, before I answer that, I would back up on one point. I mean, Adam touched on this. I would just elaborate a little. Yeah, he mentioned if you're buying 100 shares of stock, that's a big outlay. Like you're having to put a lot of capital up to make that trade, whereas one option contract is for 100 shares. Like that's how that works. So the cash outlay, given dollar investment size, is much smaller with options. So you're putting up less money up front. The risky aspect is you have to be very confident in your trade because there is a time component to it. Whereas with a stock market investment can be open-ended. You can buy the stock and hold it for 20 years if you want. Whereas options have a finite life, so you have to be more confident in the timing of your trade. but in the sense of how much dollar, what is the dollar amount you're putting at risk, you're able to control a larger position size with a much smaller initial outlay. So in that respect, I agree completely. Options are actually less risky if you know what you're doing, if you trade appropriately. Now, as for how much of your portfolio you should have invested, I think you have to look at this on a trade-by-trade basis. You wouldn't put 75%, even 25, even 10% of your portfolio into a single options trade. That would be crazy, because there is, there is a binary aspect. As Adam said, you can lose your initial investment. So you're not going to put some huge amount of money into a single trade. I mean, Adam probably has, I know he has his own guidelines on this. My rule of thumb is I wouldn't risk more than 1% or 2% of my portfolio on any single trade.
Okay. All right. I think that's fair. Now, this is where we get a little deeper into things, and I'll go back and use the example. Let's say I am a new trader, a new investor. I've never done it before. I have no idea what I'm doing. Adam, walk me through what an options trade is like.
Yeah, I mean, it sounds complicated. There are more variables and there's more terminology or jargon lingo around options. But truly, placing a trade is no different, is no more complex really than placing a trade on shares of stock. Okay, so you're going to type in the symbol, you're going to tell them how many contracts you want to purchase, and you're going to hit the buy button. You can either buy at the market and you'll get the best available market price according to the market maker, or you can set a limit price. A limit price is a great tool to use whether you're trading options or stocks. Basically, a limit price is, as the name suggests, you're going to limit the amount of money, amount of capital that you're willing to put into that trade. So if you want to limit the amount of money that you put into a certain options trade at $300, you would put in a limit order for $300 or $3 per contract. And if the market can fill you at that limit price or better, meaning at a lower price, it'll fill you. And if it can't, it can't. So that's another good, just an order entry technique. But that's true for stocks and options. But really, I mean, all you're looking to do when you're trading options in my style of options trading, which is mainly what I do in Cycle 9 Alert, is you're looking to buy an option contract at a price that you think is reasonable. I help you with that. And then we're looking to sell that same option contract 2 to 3 months down the road, sometimes 4 months down the road, for a much higher price. And again, I do all the work for you. I tell you the exact symbol to use. When you trade options, you need to choose the expiration date. Like how far out into the future do you want that option to expire? The farther out into the future, it gives you more time for the trade to work out for you, but the option is more expensive that way. You also have to use a strike price. The strike price is a big driver of how much volatility there will be in that position, how much leverage is in that position, and your probability or odds of winning on that position. So again, those are two variables that most novice options traders shy away from because they're not sure how to pick the strike price. They're not sure how far out to go in expiration dates. And they're certainly not sure what delta and gamma and theta and vega mean. So I try to make it really simple at Cycle 9 Alert. I give you all that information. All we're really doing is buying a contract today and aiming to sell it for a higher price 2 to 3 months down the road. And that's all we do.
Now, can you get out of an option early? I mean, if I set a contract for 3 months down the road and I decide in June that I want to sell it and be done with it because I just don't see it happening, can I do that?
Absolutely. And I would say 90% of the time, that's what we do, certainly on the profitable trades. And I'm glad you raised that question. We aim to be in a position in Cycle 9 Alert for 2 to 3 months. We do that because that's the sweet spot of the momentum algorithm that I designed. We know that our odds of a successful high profit trade are best over that 2 to 3 month time period. Anything shorter, we get closer to 50-50. So we're really targeting that 2 to 3 month time frame. And what I'll do is when I recommend buying an option contract, I'll recommend one that doesn't expire for 5 or 6 months out, with the full intention that we will trade out of that option well before it expires. We do that mainly because options are a wasting asset. When you put $300 into an option contract, some of that $300 is going to erode over time. And so what we want to do is kind of buy an option contract that's going to erode slowly. And if you give yourself a bit of cushion, meaning if you want to hold the option contract for 3 months and you buy one that doesn't expire for 6 months, then you have that 3 month cushion of time value so that the option doesn't erode as quickly. And that allows you, if you get the meat of the move correctly, meaning if you're making a bullish play and you get a rise in the stock price quickly enough, then you can more than overcompensate for that amount of time decay.
And I think that's important to understand, because I think when you mention that you lock in a contract and it's for a certain period of time, I think mentally people have that belief that, okay, I've got to hold it for that period of time, and that's not true. You don't. You can sell that at any time, and I think Adam's Cycle 9 alert service illustrates that, and a lot of options traders that are who do it for a living do that. They don't hold the contract for the duration that they set it for. It's just a buffer, if you will. And I think that's one important thing to understand. Charles, I'm gonna lob a softball in your general direction, but it's going to be more of an elementary. It's going to be an elementary school question. I'm going to be the teacher. You're going to answer it for me. Tell me the difference between a call and a put option.
Sure. A call option gives you the right, but not the obligation to buy a stock at a specified price within a specified time. So if you're bullish on a stock or whatever, a commodity, anything, you can buy a call option. A put option is the opposite of that. You're buying the right, but not the obligation to sell at a specified price within a specified time. You can think of a put option as insurance. You're buying insurance because you're worried something may fall in value. Or if you're just bearish and you want to speculate on the downside, buying puts is a safer way to speculate on something falling than short selling. Short selling is one of the riskiest things you can do in the market, because you always run the risk of getting short squeezed. Now, I know plenty of guys that are professional short sellers. They manage the risk. They do a fine job. But they'll be the first to tell you the safest way to short something is by buying a put.
Okay. All right. And again, I want to try to keep this as simple as possible, because again, you can't make the assumption that everyone is as schooled as you two are, or in a smaller degree as I am, I guess, in terms of how to play the options game. Now, the other thing that I think is key here is, and what all investors look for, and that is returns. How much money can I make? How much money is there to be had by trading options? And what is surprising is that your options gains, if I understand correctly, and Adam, I'm going to let you take this, your options gains can exceed a normal across the board stock trade by hundreds of percent. Explain that. Why is that?
Sure. I mean, there is leverage inherent in options. And what I mean by that is that for a few $100s rather than a few $1,000s, you can control the same 100 shares of stock as if you had bought it outright. So again, the example is you could either put $10,000 into 100 shares of $100 stock if you're buying it outright, or you could buy an option contract that may only cost $250. Okay, so that's kind of where the leverage is inherent in that. Now, leverage is a bad word, has a bad connotation. It's just like the boats. If you know how to use leverage, a modest amount of leverage correctly, it can be a great tool. If you don't know how to use it, then it can certainly lead to bad results. But that's why we do all the work for you. So just as a few examples, I mean, right now, currently Cycle 9 readers are in 2 plays on the biotech sector. One of them is a diversified biotech sector, broad-based sector ETF. So that doesn't move as much as individual stocks. The other is an individual stock within the life sciences space, a company working in genomics. And both of those, we've been in those plays for only like 2 to 3 weeks of the past 2 to 3 weeks. The ETF has moved around 7%. The stock has moved around 10%. But both of our option plays are up about 40 to 50%. So that kind of gives you an idea of, roughly 5 to 1. If you get a stock moving 10%, you're probably going to be up about 50% in the option. If you're up 20% in the stock, you may be a double. You may be up 100% in the option. So that's a rough idea of what the leverage is. It's not always 5 to 1, but that's kind of a rough idea of what you get. But the great thing I love about options is related to your question, is the asymmetry of risk and return. So if you put $250 into an option contract and it's just a complete dud, the trade goes completely against you immediately, there's no way to repair it or to salvage it, you're going to lose that $250. That is 100% of your initial investment. But on the upside, your profit potential is not capped at 100%. You can make 200%, you can make 300%, you can make 400% on an option return. And in fact, we do that routinely. So that's what I like about the asymmetry of that, is that you can't lose more than X, but on the upside, you can make 2, 3, 4, 5 times X. And when you're running a strategy that has better than 50-50 odds over time, that just really works in your favor.
Yeah, the rewards are almost endless when it comes to options. You really just have to know what you're doing. I mean, it's just not one of those things you can just sit down on your Robinhood or on your Charles Schwab account or on any account and just say, you know what, I want to buy an option. You know, you can do that by all means, but you want to be somewhat educated. You want to understand the lingo. That's why I asked Charles, what's the difference between a put and a call? Because there is a difference, and if you put in the wrong one, you're going to lose your investment. If you put in the right one, you have the opportunity to make 200, 300, 400% gains. It doesn't happen all the time. Let's be clear. It does not happen all the time. It's not an automatic. You can lose just as much as many times as you win. But in terms of risk, I think the asymmetry of it, as you mentioned, Adam, is dead on. And I think that's what should make options a little bit more inviting, especially to beginning investors, because then you're looking at risking much less upfront until you start to become a little more seasoned. But my guess is that if you play options from the start, and you start seeing those returns like your cycle 9 alert portfolio sees or things like that, you're probably not going to want to trade across the board stocks. You're probably just going to keep playing options because you know how it works and you know how it is. Now, and I don't want to get on this too much because I think it gets really deep, but you mentioned drivers of options, and there are a lot of drivers that can push options in one direction or another. And I want to touch briefly on those. Actually, I want you to touch briefly on those, Adam, and talk about kind of what those are in a 35,000 foot view of what those drivers can be, because there's a lot of them.
Sure. I mean, one of them I've already hit on, which was basically time value, or what we call theta, as far as the Greeks and options are concerned. So basically, that is value in the option that is going to slowly decay to zero at the end of the expiration. So when an option expires, it has $0 worth of time value. And what really matters at that point is whether the stock is in the money or not. We can cover that another time. But again, that's one factor that a lot of folks get wrong if they're just trying to go it alone, if they don't know how to incorporate theta or time value into their strategy. So again, I know that the window of opportunity for cycle 9 trades is 2 to 3 months. I pick an option that's 5 to 6 months out so that we don't get penalized for the majority of the time value decay that we know happens with options. And that's something that most people don't factor in. So that's one way I factor that in. Another factor driving the options pricing is called vega, which is basically volatility or implied volatility. So what happened during the recent corona crash is that basically the price that real market traders and investors were willing to pay for options went much higher than it had been in recent past. So basically they were saying that they were expecting a ton of volatility ahead, and that made buying an option contract more expensive. Anytime you're buying an option contract that has implied volatility today is much greater than the historical volatility of the stock in the past, in the rearview mirror, you're basically paying for a rich or an expensive option contract. And if volatility then going forward crushes down, and if the stock isn't as volatile as people were expecting, then that is a significant headwind against your option position. So you're buying it at one price and you're going to have a headwind. And so that's another factor that I really keep an eye on. And that's another factor that retail investors often don't account for. They basically see a stock they like, they think it's going to make a certain move, and they might be right. But if that option contract is priced too expensively based on its vega, then they might get the direction of the move correct, but still lose money or make a very little money on the option. That's something I account for when I give a specific options recommendation. I've already checked that we have enough theta in the option. I've already checked that the implied volatility is cheap enough to warrant buying that option. And that's frankly why during the meat of a crisis, basically during the first 2 to 3 weeks of March, I was telling subscribers, look, we can't really do much. We don't really need to do much right now. We don't want to be buying new options right now because they're so darn expensive. And the options we do have, they're basically directionally wrong, but they are being pumped up and held up by that same factor. So again, if you didn't follow that whole discussion, that's fine, but just take from it, we factor that into our recommendations, and we give you the simple, specific recommendations that allow you to trade the options, buy in today, and hopefully sell them 2 to 3 months down the road for more.
Well, Charles, I'll throw you a question here. Again, I just feel like an elementary school teacher asking questions here. But are there particular sectors that are good for options as opposed to others, in your opinion?
Well, as a general rule, I would say the sectors that tend to move more are a bit more appropriate for options. But really, you can write options on anything. They're completely appropriate for any sector. They're just a lot more interesting in the sectors that tend to have a little bit more movement. I would actually like to piggyback on something Adam said.
Sure.
Volatility is sort of a bad word in investing in general. People are just scared of volatility. But if you're in a period of low volatility and you're in options positions and volatility explodes higher, that is not necessarily a bad thing. As Adam said, the options get expensive when there's a lot of implied volatility. So if you're in an option that segment of it, that driver of its return, that volatility part, if that blows out, even if you were directionally, your trade may have been hit or miss, you could actually make money just on the volatility alone. So volatility is actually the friend of an option buyer.
Interesting. That's an interesting take. I think another takeaway that I think people listening should have is that volatility is not necessarily bad. It is. It's got it's a horrible word, especially when you're talking about the broader market. When you hear volatility as an investor who's not a trader, you probably start to cringe a lot, and that's why the VIX.
Volatility for the option seller. Well, volatility for the option seller can be a death sentence. If you're selling options. And what Adam does is he buys them. He's primarily an option buyer. Volatility can be a death sentence for an option seller, but it can be the best friend of an option buyer.
Yeah, and I think one thing to kind of blanket over this whole conversation is that options have the potential to be as complex as you want to make them, because there is a lot to learn, but once you learn it, you have it. But there is a steep learning curve to it. It's not that it's difficult. It's just there's a lot of moving parts that can play a factor in it. So I think when you look at, as an investor, trying to decide, okay, do I want to get into options because Adam said there's big opportunity for gains. The risk is relatively low. But how do I go about it? I think one way you have to look at it is you have to look at someone like Adam who does this for a living. He provides this kind of information to people to say, look, this is what you should buy. This is how you should buy it. This is the ticker you put in. This is how you enter the trade. This is the duration of the contract. And oh, by the way, here's why we're doing it. Not just doing it just because Adam said so, but he's actually providing, sound rationale as to why that's the case. So I think that is a direction that, as a new investor, I would certainly look at. If you're wanting to play into options, Adam has his Cycle 9 alert, which is a actively traded options service that he provides here with money in markets. And now I'm not trying to shill it by any stretch, but I mean really, if it's something that you're wanting to do as you're learning the process, Adam can certainly help you with that. I mean, he's got a great trading manual that kind of walks through the rationale of it. We've got resources on money in markets. I will shield myself for a second. They'd write an extensive options guide on money in markets that'll be linked in the show notes below, that you can certainly take a look at, and it gives kind of the broad overview. But if you're wanting more in-depth information, more substance to that, other than just here's what this means, here's what this means, and here's what this means, then Adam is someone that you want to look at as being a provider of that information, because he certainly can do that. He has done that, and he's got a proven system with Cycle 9 Alert that has paid his followers handsomely. Not going to give away the farm like we don't do, but his track record with options is it better than 10x, or is it as good? I want to say it's better, but I don't want to damper that. Is that true? Is your track record better in Cycle 9?
It's like asking a parent which child they love more. They're totally different systems for different types of investors. I have plenty of subscribers that are in both services, and they use them as a complementary in combination, basically, because as the case may be, sometimes when one's doing a little bit better, the other one's not doing as well, and they kind of even out. But really, they're both easy to trade. Both of the systems, my goal was twofold. It was really to speak to two audiences. I wanted, if you wanted to follow the strategy, whether it's Cycle 9 or 10x profits, and just follow my simple, specific, crystal clear buy and sell signals without knowing why or without knowing anything underlying that you could follow that with good success. At the same time, I wanted somebody that was maybe more interested in learning the nuts and bolts of options, or more about learning about market timing and what drives that type of behavior, that they could also in the same exact service get enough information to kind of continue learning the in-depth parts of it. But again, like if you're just wanting to come out and follow the trade signals and stack profits over time, we can do that as well. But at the same time, I want you to understand the why, because I found that if an investor understands the why behind the trade they're making, they're a lot more willing to be committed to the trade, which is important.
Yeah, I mean, and that's the thing. I mean, we've talked about this before with Adam, and that is, if you're going to have a system, stick with it. But in order to get into that system and to have that mental block erased to where you can stick with it, you have to have an understanding of what you're doing, and or at least an understanding of the information that you're reading that Adam provides. And I think that's key. And Adam does that. He provides that information on any time that he makes a trade recommendation, whether it's to buy or sell in 10x, or whether it's to buy an options contract in cycle 9 alert. There's at least a good amount of information saying, okay, I told you to do it. Now here's why I told you to do it. And that way, I think investors would feel more at ease, understanding that, okay, that makes sense. I can do that. I understand that now, and it makes it more tangible for them. So I think that's another great thing to point out. So if you're wanting more information on Adam's services, log into moneyandmarkets.com. If you click at the top, you'll see premium services. You don't have access to them, but you can certainly kind of get an idea of what they're like. Encourage you to do that. Any parting shots, Charles? Anything for the long weekend?
I would just say if you've ever been curious about options, but you've been a little bit intimidated by it, or you were scared to get started because you just didn't know how they worked, this is a good opportunity to get your feet wet. Adam will walk you through it. That this is what he does. He walks you through the trade. He helps you understand it. So if you've ever wanted to experiment with options a little, this is your chance.
Absolutely. Adam, any last shots for the weekend?
Yeah, I mean, one thing options allow you to do is get into more plays. So right now, I think that it's going to be a great environment for stock picking. With this basically sea change that's been caused by the COVID crisis, there are some industries and sectors and stocks that are just absolutely not going to come out the other side of it. There are other industries and sectors and companies and stocks that are going to be just catapulted higher because of it. And so I really think we're in this kind of bifurcated environment where some, the haves and the have-nots. But at the same time, we're going to have a lot of volatility. So you go back to the old adage of diversification. Is it better to own one stock for $10,000, or is it better to own 10 stocks at $1,000 each? It's obviously better to do the latter because you get the free lunch of diversification. With options contracts costing so little, $250 or maybe $500 per contract, a retail investor that may have a smaller dollar account can spread that money across more plays and become more diversified than if they were to put the same amount of money in just one stock. So again, I think that it's an ideal environment to be able to put more money into more plays right now when everything's kind of in flux.
Very good. I think those great points by both of you, and I appreciate you guys coming on today. Make sure, again, you can check us out if you want the podcast downloaded, so you can listen to it on your mobile device or on Alexa. I found out apparently you can listen to our podcast on Alexa. I didn't even know that. But you can do so. We are on Apple Podcasts. We are on Google Podcasts. We are on Spotify. Now we are on iHeartMusic, and we are on a vast other number of podcast hosting platforms that I didn't even know existed until I started this. So that's interesting. Also, you can check us out on YouTube. Subscribe to the channel. By all means, you get updates on when we post videos. We're going to start rolling out more and more videos as time goes on. So make sure you stay ahead of the curve and get ready for that. Adam, appreciate the time. Thank you for coming on. Charles, you as well. And I hope you guys all have a great holiday. And we will certainly talk to you guys all next week. Until then, this has been the Bull and the Bear podcast. I'm Matt Clark, and have a great weekend and safe trading.